Now, what happens when we're in a subsequent year, any year after acquisition, when we're using the initial value method? Well, the investment recorded by the initial value method um, in 2023, Sun had net income of $160. They declare and pay dividends of $70,000. Acquisition, remember, was 1/1/20. So this is the accrued net income totaled up. Accrued, dividends declared, and therefore the increase in the book value. Remember, dividends received are recorded as dividend income. No equity in the subsidiary earnings is recorded. No excess amortization is recorded, and the investment account therefore remains at the initial value. However, consolidated financial statements require a full accrual-based measurement of both income and retained earnings. The initial value method, however, recognizes income when subsidiary declares a dividend and ignores the underlying income that was earned. So, the difference in retained earnings, if you use the equity method, would have had 330 less the 21. In the initial value method, we have only dividend income, and in partial equity, we record the 330, but we ignore the dividend income, of course, because it's wrapped into our equity accrual, but we ignore the excess amortization also. So if we use this, we add one more entry, which is a star C entry. And the star C entry is that we're going to increase the investment in Sun and increase our beginning retained earnings to convert to the equity method. That 199, wherever I had it, the 199 difference that I had between the methods. So SAID, E, and we should make note that patented technology, there were 3 years of excess amortization, so now we're going to increase the value by only $91,000. That's our excess cost here. The equipment went up by $12,000. Then we do our amortization. There's our 199. If the equity method had been used, we would have accrued 199. So now we're going to increase our investment by 199. The retained earnings are going to increase. So that's actually the first entry you think about doing. 199, I know these are together, they're hard to see. This is the C, the star C is over here, 199. Okay, and then you have the S, which is just to consolidate, to get rid of the common stock, the additional paid-in capital in the beginning, retained earnings of Sun. Then we want to write up or adjust this for the fair value, but then since we've ignored the excess amortization, we have to put that excess amortization in there. So that's why this is 91 instead of the initial amount, 39 more, because we haven't done the excess amortization. Goodwill doesn't get amortized, and the equipment actually got written up. The excess amortization decreased, the value went up. All right. So this again is just a check figure. Okay, so that's the excess allocations, amortizations in the previous 3 years. There's no entry to eliminate the equity in the subsidiary because there is none. Our dividend income is against dividends declared rather than an investment, but dividends declared and dividends income here. We record out excess amortization for the current year, and we record the intra-entity or company transactions here. Put them all again in our financials, in our worksheet. I guess I'm going to remind you of this again. Net income flows down to retained earnings. Whatever we get in retained earnings, pick a nice color here. Whatever we get in retained earnings goes all into the next financial statement, which is the balance sheet. So that's how we get these numbers. We're not coming across with anything. We're not worried about that. We're coming down with these because that's the way it's supposed to work. Remember, when you're adding down, not across for the total, down, not across from the total, and this one has to come from here. I guess that's it for the subsequent years using the initial value method.